Good morning. Welcome to Monday's Trading Hour. I'm Reema Tendulkar. With me is Sonal Boothra in the red now for the Nifty and the Sensex, but absolutely flat, actually, you would say. The Nifty is just above that 24,200 mark. The Sensex is down 330 odd points. Autos, Pharma dragging their feet, while IT is on the front foot. Nifty IT is up more than 1%. PSU banks are seeing some buying. And the story is in the broader markets. The mid-cap index and small-cap index up nearly about 0.5% with a positive advanced decline ratio.
You're still getting Monday blues, right?
I said Monday.
Okay.
So it's Tuesday trading hour.
No worries. I think we all are in that zone now. But so is the Nifty today, right? So after that rally that we saw yesterday, today also we started in the green, but we have come off from the highs of the day. Absolutely flat. Nifty is back again in the green. Mid-caps are doing well. It's a Nifty Realty pack that continues to do well. It was a big gainer yesterday. Today as well, we are seeing some gains come by. So 1.2% higher on Nifty Realty. That continues to be in focus. Nifty IT is contributing, or at least supporting gains on the Nifty for now. So be it Infosys, be it the other tech names, all of them higher in trade as we speak. While the mid-caps are doing well, small caps are outperforming mid-caps. So 0.7% of a gain is what we are seeing on the small cap. The FMCG and the consumption pack doing well as well. But overall, we've come off from the opening highs. We'll have to see whether we continue that momentum or we see some add-on buying on this. But this is what the market is looking like at 11 a.m. today. But let's move on and talk about an important story. Sources to CNBC-TV18 suggest that FDI cap on insurance sector will likely be raised to 100% from the earlier 74%. Sapna Das is joining us with all those important details. Sapna, what are you picking up?
Yeah, hi. So that's exactly what you have pointed out. There is a full plan on the part of the government, along, of course, with the regulators. A lot of consultations happen on this front. So the sense that we have is that most likely this cap is being supposed to be raised to a full 100%. And it's quite likely that, the insurance law amendments, whatever bill changes that will be required to facilitate this, probably the bill amendments, could be tabled in the ongoing winter session of the parliament. That's basically the aim of the government. So that's one, of course, the FCI 100% cap is one. The second aspect, of course, is also the fact that, since a pretty long time, the regulator, along with the government and various other stakeholders, they have been talking about composite licensing for the insurance players, both general and life insurance players. So that would basically enable, companies to basically diversify their product portfolio. A life insurer can do health insurance as well, and maybe likely vice versa. Of course, there'll be a lot of terms and conditions for that, and what could be the capital adequacy norms, all of that. So that remains to be seen, but that also is likely to be a part of the proposal, the overall raising of the FDI cap to 100%. Last but not least, also insurance agents, intermediaries, the cap is already 100%. The government has done this quite some time back. However, there's a cap that they are not able to sell policies, multiple policies, like basically, selling policies only of one life insurer and probably of one general insurer. So I think that is also going to be done away with. There will be other delegated legislation that will follow once the law amendments have been cleared by the parliament. So we have to wait and watch for this.
Thank you very much for that. In fact, Debashish Panda, the chairman of the insurance regulator IRDAI, had spoken to us just a few days back and given an inkling, the possibility that the FDI cap will be raised to 100% from the current 74%, because the sector per se needs a lot of capital, and bringing in increased FDI also brings in the global expertise and technology. Listen in to what Mr. Panda had to tell us earlier.
If we depend only on the domestic resources, so then the crowding out effect will play out. So therefore, we have to perhaps look at FDI also, and if 100% FDI is allowed, along with the growth capital or the required capital, it will also bring in global expertise. It will bring in, capacity, technology. So all of that will definitely bound to happen. So perhaps this has become the opportune time for, having 100% FDI. So what will help potentially to the 100% is that it will play out in the sense now the players will come with 100% FDI. They can plan their business independently. They can decide on their growth plan. They can decide what kind of business they want to write. They can infuse the capital very promptly and easily because they don't need to depend upon their domestic partner. So all of this will also be a concomitant benefit which will accrue. and therefore, we need to perhaps think about. But however, I'm sure that the government will take a decision on this at the appropriate time.
Chairperson, sir, you've been doing a lot of roadshows overseas as well. When you speak to a lot of these foreign investors and insurance companies, what do they have to say? A couple of things that they have to say in terms of what could 100% FDI give it to them, which let's say a 74% didn't.
No, that's what I just mentioned. They can plan their businesses independently. So you don't need to search for a domestic partner who would match their expectations. Then they would decide what will be the growth plan. They would bring in the capital as per their own plan and design. So all of that flexibility will come in, and they will be able to, grow the manner in which they intend to grow. So, so that will help by allowing 100% FDI.
Okay, that is an important story that we are tracking, and we'll keep getting you more updates on this one. So that's about the insurance sector. But let's also talk about the microfinance institutions. There are some updates there. There is tightening of the lending norms as well. Abhishek is joining us with all the details.
Well, we did highlight about, the pace of growth slowing down for microfinance institutions, as well as the fact that their NPAs are cropping up, and, there are over-leveraging by lenders happening over there in May of 2024. Now we have a microfinance industry network, that is MFIN, which has taken additional measure to ensure strengthening of MFI operation and also responsible lending by the lenders. So MFI sector at present caters to the financial needs of nearly 8 crore, low-income people in the country. So microfinance institution has tightened lending norms for its members, wherein they have capped the number of lenders to a customer to 3 from earlier 4 that were there, and they have capped maximum indebtedness of ₹2 lakh per customer. So no lending to any borrower who is overdue of more than 60 days past due for any lender, and they seek PAN, that is, the PAN accreditation for at least 50% of their borrowers by the end of FY25. Interest rates will be closely monitored and reviewed by the board of the members regularly. So these measures will come into effect from 1st of Jan 2025. Measures have been pertaining to facilitate responsible lending in the space and prioritizing customer protection, as well as promoting a steady and calibrated growth for the sector. Back to you.
Thank you very much for that. Moving on now to the news from the telecom space. Now, Vodafone Idea is surging after the Union Cabinet has approved a waiver of bank guarantees for telecom companies. Ashmit is here joining in with the details. Ashmit.
Right, so a big relief coming in for the telecom companies, especially for the likes of Vodafone Idea, which were looking at large liquidity issues on account of these bank guarantee requirements. Now, here's the crux of the story. In 2021, the government had decided to exempt bank guarantee, had to waive bank guarantee requirements for spectrum that was acquired in auctions in 2022, 2024, and so on. The demand that came from the industry is that if the government is open to the idea of waiving bank guarantees, then why not also waive bank guarantees for spectrum that was acquired previously, before 2022. And that is the concern which in fact found some merit with the DoT. The DoT had considered this request, had placed it before Cabinet, and what we've learned from sources is that late last evening the Cabinet has granted its approval for waiving off of bank guarantees. So the bank guarantees that were submitted on account of spectrum acquired pre-2022 can now be claimed back by the telecom companies. That's the meat and substance of this is a relief that has come by way. A couple of clarifications. Number one, this is not company specific. This is across the board for the entire sector, number one. Number two, while the Cabinet has granted its approval, it is yet to be formalized, so we'll have to see the format in which this gets actioned. And number three, this, in terms of takeaways, this will largely impact Vodafone Idea, which has outstanding bank guarantees to the extent of somewhere in the neighborhood of 25,000 crore rupees. So that will, Vodafone Idea is likely to be a huge beneficiary. Bank guarantees submitted by Bharti Airtel and Jio, of course, will also stand to benefit on account of this decision by the Cabinet. Back to you.
Oh, yes. Thank you so much for joining us with all those details, Ashmit. Vodafone Idea, clear gainer, 13% higher on that stock, though it has come off from the highs. At a point in time, it was up around 17%. We'll do one thing. We'll slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned. Welcome back. You're still tuned into Trading Hour. It's time to talk all about commodities now. Manisha Gupta is joining us as always. And today it's all about gold. Is it sparkling or lower, Manisha?
Well, it has come off its highs. Remember, last week we saw gold prices gain up by 5%. It was the best weekly gain in 2 years. But overnight on Monday, we've seen prices come off by nearly 3%. Silver fell by 3.5% as well. Platinum was down by 3%. Palladium fell by 5%. So it has been a very sharp decline. But in the markets right now, we saw some buying on the lower side here. And that is one because of the U.S. meeting minutes that get released today. And then apart from that, U.S. pledging higher tariffs on products, not just from China, but Mexico and Canada as well, mean higher inflation. And that in turn seem to be supporting gold and silver prices. Having said that, there are way many factors which have continued to weigh onto the prices. To begin with, Israel and Hezbollah now nearing a ceasefire agreement has taken some safe haven buying off these markets. The second thing is about Trump nominating the hedge fund manager, Stock Bessent, as Treasury Secretary, also has taken some uncertainty off the markets, and Scott is seen as a strong one when it comes to interest rates, which also the markets feel will not be cut at the pace that the street was anticipating earlier. Actually, when you look at the CME Fed tool, it says that there is just about a 56% probability that you could be looking at a 25 basis point rate cut in the month of December. That also seems to be weighing onto the markets there. So where we stand right now, it does look like it's going to be a range for the gold prices. Remember, the all-time high has been at around 27.90. We are far away from that. But a recent low of 25.30 also seems far away. So it really is going to be a range of around 26 to 2700. Within that, the gold prices could trade for the rest of 2024.
Okay, thank you very much for that. We will slip into a very short break on that note. We'll come back and talk technicals. Mitesh Thakkar will join in on the other side. Stay tuned. Welcome back. The Adani Group stocks continue to remain under pressure. So Adani Green is down 6.5% today. Adani Energy is down 4%. Enterprises and Adani Ports down about 2.5%. And even Adani Power and Total Gas are reeling under cuts with close to about 1.5%. So the entire basket is a bit subdued in trade again. But Emcure Pharma is surging, and that's on the back of a Kotak upgrade. So why has Kotak Institutional Equities upgraded Emcure Pharma? What's driving that? We have Vamakshi joining in with the details.
Well, Reema, this upgrade has come on the back of better prospects for the company. Now, keep in mind that Emcure had a decent first half, but going into the second half of the financial year 25, Kotak Institutional Equities is expecting a pickup to come through. Now, organic growth in the first half was somewhere around 6%, and this is estimated to rise to 9% in the second half. And this growth would largely be driven by upbeat prospects in India, Canada, as well as the rest of the world. Now, organic growth coupled with the in-licensing deal with Sanofi, consolidation of Mantra, and with the legal challenges likely behind them, they are expecting a 13% overall sales CAGR from FY24 to 27. In fact, in the same period, they're expecting 18% EBITDA CAGR and 29% EPS CAGR, and this would largely be driven by improved productivity as well as higher utilization of their facilities. Now, from the recent highs, the stock has seen a fair bit of a correction, and Kotak Institutional Equity says that post this recent correction, they find the valuations to be attractive, and given that, they've gone ahead and upgraded the stock to buy from AD. However, they've maintained their target price at 1,680 per share, so they see roughly around 20% upside from the current levels. Okay, 20% upside from current levels. The stock is out 5% already. Thank you so much for joining us, Vamakshi, with all those important details. Let's now focus on the defense stocks. They're buzzing in trade. Nimish highlighted these stocks in his standout brokerage report of the day. Let's revisit them. Nimish, over to you.
Well, both the stocks are buzzing in trade, largely on the back of a big report from JPM. So they've initiated coverage on the stocks with a buy rating on BEL with a target price of 340 and a buy on Hindustan Aeronautics with a target price of 51.35. So meaningful upsides from current levels. They also have a neutral rating on Mazgaon Dock and with a target price of 40 to 48. Now, the key reason for initiating and being bullish on the defense sector largely because they believe that the sector represents a long runway of structural and value accretive growth, and for multiple reasons. The first reason being the increasing capex. So they forecast $150 billion of capex in the next 5 years versus $85 billion in the previous 5 years. Second, they see a large export market as well. So they expect a 46% CAGR over the next 7 years for as a export opportunity for the Indian defense companies. And third, the focus seems to be on domestic manufacturing with high ROCs as well as strong cash flows. So after the recent correction, JPM believes that it's a good entry point to get into this incumbent Indian players, because they see a 15 to 17% EPS CAGR as well as high ROE between 23 to 33% for the Indian defense companies. So a buy rating on BEL and HAL and a neutral rating on Mazgaon.
Okay, thank you very much for that. And Nimesh, congratulations. Just recently you were telling us about GE Vernova, and that's down by nearly about 5%. Fill us in with the details. Well,
so obviously, the stock is reacting a negative 5% because the promoters have announced an OFS. So the promoter entity is looking to sell 8.3% stake via OFS. So the floor price is set at 1550, much lower than yesterday's closing price of around 1900. The book will get built for the institutional investors today, and for retail investors, it will open tomorrow. Today, the pricing will be quite interesting as to at what price the institutional investors bids come in. Normally, that happens in the last 15, 20 minutes of today's market. So that needs to be tracked very closely. On back of that, the cutoff for the retail investors will be set for tomorrow. The more other important thing is after the stake sale of 8.3%, the promoter entity will be left with 51%. So the further supply looks unlikely. This has been the second tranche that they've sold in this calendar year. They sold a large chunk a couple of quarters back, and now they're selling another 8.3% via OFS. So today, last half an hour will be quite interesting to see as to where the cutoff price comes in. But yes, it's a large block of 8.3% where the promoters are selling out in GT&D.
Okay, all right. Thank you so much, Nimesh, for joining us with those important details. Those are some stocks which are on our radar, but it's a good time to get a technical check on the markets. Mitesh Thakkar is joining us just for that. Mitesh, good morning. Thank you for joining in. Well, we've come off from the highs. We are absolutely flat, I would say, with some negative bias. What are the next important levels? Do you think this dip could get bought and we'll see higher levels by the end of this trading session?
Yeah. My understanding is that, the Nifty is going through a pullback process, and 24,350, which is where a couple of averages also placed, has emerged as an important pivot. So yesterday's high was 24,351. Today we got 24,343. So I think after rallying by nearly about 1,000 plus points, I think the Nifty might do some consolidation before it continues with the pullback, because the hourly and the 2 hourly averages are still pointing on the upside. So decline should be bought into, but at what levels? 150, 120 on the spot, which is roughly about 50-70 points lower from here, is my buying zone. I think that will be a good level to buy and keep a 70-odd point stop loss. And on the upside, 24,350 is the first target, with 24,500 as the next area.
What about stocks, Mitesh?
Yeah. So on the stock side also, I have buy calls. I have a buy on Reliance. Disclaimer, we have recommended it to our clients, so there's vested interest. Reliance has a buy with a stop at 1274 for targets of 1320, and that could, in theory, also help the Nifty propel or move up higher. And the second buy call is on IOC, which I would recommend buying with a stop at 135.5 for targets of 141.
Okay, all right. Right. These are the two technical picks that Mitesh has. Reliance otherwise as well. Fundamentally, a lot of upgrades have been coming in from different brokerages as well. So that stock is on our radar. But we'll do one thing. We'll slip into a short break. Up next, we'll discuss the market fundamentals with Christy Mathai from Quantum AMC and the top sectoral bets as well. Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals now. Christy Mathai from Quantum AMC is joining us now to discuss that. Christy, good morning. Thank you so much for joining in. Well, you know, a lot has happened in the month gone by, or in November itself. We've seen geopolitical tensions emerging. Then we had the Trump election. Then we had our own earnings, which saw big downgrades coming in as well. What's your take on the markets right now? Do you think we'll see more consolidation? And what's your take on Nifty earnings for FY25? Have you seen some, or are you looking at some more downgrades come by? What is the rest of the fiscal looking like?
Right. Thanks for having me. So I'll just start with the earnings bit. So if you want to look at, how the earnings season has been, just for the last quarter, what you've seen is a fair bit of downgrades across the board, and it is more prevalent in, the mid and small cap universe as it is. Now, I think there are 2-3 reasons for that. One, of course, is, last year we had a fair bit of tailwind in terms of margin pressures, the commodity pricing going down. There was a fair bit of growth, which resulted in some operating leverage, and the margin expanded, resulting in growth across the board. But most of those parameters are sort of absent this particular year and this particular quarter in particular. So our sense is that would continue even going forward. Only caveat is, last year we had the festive seasons being bunched up as opposed to this particular quarter where it is more spread out. So the weakness that we saw in 2Q may not give you an accurate picture in terms of the broader economic outlook or broader earnings directly. So we'll get a more color on that as we progress into the 3Q. But that aside, if you look at the valuation per se and how the stocks have performed, so we've had close to about 6 to 7% drawdown from the peaks that we saw about a month back. Against that, if you still see the YTD and longer term returns, YTD returns for BSE Sensex is close to about 11%, and you look at the smaller and mid, it is in the vicinity of 23 to 24%. So those numbers are still pretty good if you were to look at within the context of earning downgrade that we have had. So our sense is this would be still again a period where we could see that sort of a consolidation, and earnings downgrade also perhaps may continue, maybe at not the degree that we have seen in the past quarter.
So Christy, on that subject, almost 2 months of this quarter are done now. What's been the feedback from corporates about Q3?
Right. So across the board, if you were to see, because it's too short of a period to gauge, but we have seen across some of the channel checks that we have done and what we have been hearing, that demand is broadly picking up. The clear picture would emerge end of November as to how the festival season. So far, things have been on track. There are some concerns with respect to specific segments. If you talk about the banking segment, there's the whole MFI pressure, which will not go away in a hurry, which might continue for some time because there have been more regulatory scrutiny that have been put up. So, the pain would perhaps continue for some more time before things show up. You look at autos, we have seen fair bit of inventory absorption that has happened during the festive period. Again, there are subsegments like two-wheelers which have done well. The CV part as well as, the passenger vehicles are still recovering, so the inventory has kind of come down. You move broadly to the, consumption space. Again, what we are seeing is some bit of improvement that we have witnessed in the festive period. And hopefully, the second half should be better than what we have seen in first half because they were marred by a lot of one-offs, including election, the bad monsoon period, the strong monsoon period, which caused a lot of upheaval in certain states. And, the festive periods being a bit different from last year.
Okay, so second half could be better than the first half. In that case, are you finding any pockets where you think it could be the right time to invest, or are you waiting for further correction?
Right. So as of now, the current, given where the valuations are, we are not aggressively deploying whatever cash that we have left, in our funds. We are being very cautious in that sense because our sense is the valuation still continues to be on the higher side. If you were just were to look at the bank, Nifty index or any larger index and just strip out the banking and financial services, which have not done for some time, the valuations across the board remains on the higher side. So selectively, we are adding in some saving related themes within the financial umbrella, be it in insurance. We have been adding some portion to the banks, again, private sector banks, where in a way we see, the crisis that is happening within the unsecured and the MFN, microfinance. Most of these banks are a bit immune to that because either they are, very small in the larger scheme of things, or they have not much exposure. And we are seeing some of the quality franchising being differentiated, mostly in the private sector bank. And also, we have kept our allocation to IT services as it is, which remains on the higher side. Given, related to the market, the IT services are still a better place, and the commentary that we are hearing now is better than what we had heard the last time, and we are seeing some of those pipeline numbers also looking good. And we have seen some of those US centric factors go away in this particular quarter. So things should look up from that perspective.
Okay, thank you. Thank you, Christy, for joining in. Get into a break. On the other side, we'll chatting with the management of Lakshmi Organic Industries to discuss their FY25 outlook. Welcome back. So Asian Paints is the top Nifty gainer today. It's up 2.3%, benefiting from the decline in crude prices. Generally, FMCG is on the front foot, whether it's Britannia or Nestle. They're seeing gains of 1.5%. So these stocks are higher on expectation that the welfare schemes has proven and perhaps it will continue. There is more money in the hands of women, which will result in essentials being consumed and purchased. So these stocks are higher. IT didn't outperform yesterday relatively, but today there is buying emerging in IT names. And IT, I think the Nifty IT index is up more than 1% with names like Infosys, Tech Mahindra on the front foot, and BEL. There was a JP Morgan note, upbeat on the entire defense pack. BEL is one of the big notable winners. Heavyweights like Reliance Industries continue on the upside. But let's get you some opinion that we got earlier today. This was opinion that we got from Ashwini Agarwal, founder and partner at Demeter Advisors. Listen in.
I'm looking for companies where I see high visibility of earnings over the next 2 to 3 years and reasonable entry point on valuations. Some textiles exporters, for example, are talking about very robust order book indications from their customers in the US. So exporters as a basket, especially US oriented exporters, should do very well. So, those are some of the areas where one can look for ideas, and that's what I've been doing. PSU banks will do reasonably well over the next couple of years at least, because they will continue to experience very muted credit costs because, they've been late to the cycle of the cleaning up. So the recovery cycle for them will continue to feed through to lower credit costs over the next couple of years. The defense or electronics manufacturing areas, stock prices have taken a huge beating, and now they might be approaching, some sensible valuations. I haven't, dabbled in that area yet, but yes, it does look interesting. The debate is really whether the slowdown is structural or cyclical. My view at this point in time is that it is a little bit of cyclical more than structural. And therefore, I'm hoping to see some recovery or rebound in the second half. Now, there's a lot of disruption taking place in retail. And if you're looking at a business that is prone to a disruption or is or may not exist 5 years down the line, then you have to be careful about what you pay.
Okay, that is some market opinion coming in, but it's time for a short break. Management of Lakshmi Organic Industries will join in to discuss the FY25 outlook. Stay tuned. Welcome back. You're still tuned into Trading Hour. Let's get the conversation going with Lakshmi Organics. Rajan Venkatesh, the Managing Director and the CEO of the company, is joining us on the show now. Rajan, good morning. Thank you so much for joining in. Will you end it first half on a strong note? It's been better than what we saw in the last couple of financial years because of the weakness we had been seeing in the chemical markets as well. Can you do better than what you did in the first half? 8% is the revenue growth. You've done margins of around 10%. What is second half looking like? What will you end the year with in terms of revenue growth and margins?
So thank you first and foremost for having Lakshmi Organic and myself on the show. I think what we've given as a guidance is for FY25, we will strive to deliver profitable volume growth. You've seen that performance exhibit in the first half. Quarter one, we had our scheduled turnaround in the essentials part of our portfolio. That's where you saw the volumes being lower. But you saw in quarter two that we have rebounded strongly. Quarter three, we had a scheduled turnaround for our specialty units. And thereafter also, everything has happened smoothly and we are back on track. So focus remains for FY25 to deliver profitable volume growth.
Would you like to put a number to that?
No, at this point of time, I would like to be a bit coy about it. I hope you can understand.
Okay. And what about margins?
Margins, I think on our specialty portfolio, the way we have been always steering is we're focusing on EBITDA. For our specialty portfolio, that has to be in the range of 20 to 25%. We closed out last financial around 24% in our specialty basket. This first half and also quarter two, we were in a similar ballpark. So that's the robustness we want to keep going also into the remainder of this year. On the essentials, you've heard this from various quarters. This is more the commodity part of our portfolio. And the sort of spreads have been on the bottom quartile. And we are navigating through, I would say, smartly at this point in time. But we have to acknowledge the fact that margins and spreads are in the bottom quartile for the essentials part of the portfolio.
Okay. You know, the other segment that is high margin business is the fluoro intermediates. The plant is expected to come on stream in the second half. You've been very bullish on this segment in general. By when do you expect the commercialization to happen? What will the initial capacity utilization be? And at peak, what kind of revenues will this particular segment see?
So we've called that out in the past. So peak revenues from that asset base that we have bought into India is 200 crores. We have said that in this financial year, so quarter four, we will achieve about 10 to 15% of that peak revenues. In the next financial, that is in FY26, we strive to achieve about 40 to 50% of the peak revenues. And in FY27 is where we will strive to achieve those peak revenues.
And once you achieve those revenues, and this is also a high margin business, right? 25%, 20 to 25%, that's the bracket. What does it do to your margin profile then? Because right now you are in high single digits or maybe around that 10% mark.
So I think again, we are looking at it from an EBITDA lens. So the fluoro part of our portfolio is also nestled under our specialty vertical. And the focus remains to deliver EBITDA in the range of 20 to 25%. And I think this is also something that will deliver the same level of EBITDA. That remains our key focus. Because again, in specialty, very different to our essentials basket, it is always about what product can you produce in the multi-purpose asset that gives you the best bang for the buck. So that remains our focus.
So you're basically targeting essential EBITDA to increase by 3x and specialties EBITDA to increase by 2x by FY28. What would be the drivers for it, and even for your capex? Because businesses do go through cycles. So what are the projections that you've made on current pricing?
Right. So let's first tackle business by business. So in the essentials basket, we closed out EBITDA for the essentials basket in FY24. We closed out about 4%, certainly below the 8 to 12% guidance we have given. But we have always said essentials is a business to be looked at over the cycle. And we remain confident to achieve that. And the reasons, one of the few triggers we have taken is also two levers. One is broader. That means we are introducing newer products. We announced the capex for a world-scale butyl acetate asset to be coming up in Dahej in the course of the next financial year. So those are having better margin profiles as compared to ethyl acetate. And also we have launched a new product of N-propyl acetate, which is going to the similar basket of customers and also having a slightly better margin profile as compared to ethyl acetate. So we will be de-risking at both an enterprise level and essentials basket our overexposure to ethyl acetate. So just to keep it in perspective, in FY24, ethyl acetate accounted for about 60% at an enterprise level when we talk about revenues. By FY28, this is anticipated to be in around the 40% range. So those are the efforts we are taking on essentials. We are continuously focusing on our operational excellence journey. That is where you're seeing the volume year-on-year and quarter-on-quarter improvement into our performance. Specialties, as I called it out, again, with the doubling of our capability at the H for our diketene derivatives, that is what gives us the confidence. We will be top 3 globally, including players in China, and we have a good, diverse portfolio of products and customers, which keep us in good state.
So, Rajan, these projections that you've made, where you will see doubling of revenues, the EBITDA growing as well, what if the cycle turns for the worse? What happens then? What are these projections made on? What pricing? Is it the current pricing, or you're already conservative in these projections?
So for where it has a large bearing is on the essentials part, and there we have been conservative. So we have certainly taken out the COVID peaks, and we have been actually looking at the quarter where we are at the bottom quartile or slightly in that ballpark. So we are very conservative, and the downside from this on spreads, I think the probability is lower as compared to the upside.
Okay, and last question before we let you go. How much is your dependence on China right now? What's the raw material availability looking like? Is it largely for your essential portfolio only? If you can give us some sense.
So from a raw material purchasing, we are depending about 30 to 40% of our raw material buy comes in from China. And I think we see no qualms in acquiring those raw materials. We are well hedged between multinational companies which are operating outside China and China. And I think at this point of time, we have long-term contracts in place. So that allows me to sleep well.
Okay, all right. Rajan, it was a pleasure speaking with you. Thank you so much for joining in today. Mostly chemical companies have not been sleeping well because what's been happening in China and globally. But let's see, better days ahead for the industry maybe. Thank you for your thoughts today.
Thank you for having Lakshmi on your show.
Okay, all right. With that, we'll take your leave on this edition of Trading Hour. But stay tuned. A lot of action lined up on Halftime Report up next.